This will be, as is the case with all of these Twitter spaces and podcasts, on all your favorite platforms under that lead lag live banner. Please do me a favor, folks, rate, review it on Spotify, Apple. Be honest, which means give it 5 stars when you do that. This will be a really interesting and thoughtful conversation with a guy that knows a little bit about the banking sector and has a lot to say as it relates to markets and where we are today. My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Mr. Porter Collins. Porter, a lot of people know who you are. A lot of people may not know who you are. Introduce yourself to the audience. Who are you? What's your background? How'd you get involved in interested markets? And what's it like seeing yourself in a movie?
Sure. Well, thanks for having me on. And for those who were just listening, there's no easy way out from Rocky IV, which was the title of our Q4 annual letter this year. So, of course, referring to the sovereign debt of the United States. So, anyway, my name's Porter Collins, and I have been doing this for a while. My partner, Vincent Daniel, and I have been working there for over 20 years, and together we started Front Point Financial Services Fund in 2002 or three, basically three. Ran that through the GFC, and obviously we're featured in The Big Short, which was a little bit surreal when they first came out, and after the book, they said they're going to make a movie of it, and like, oh, this is going to be horrible. How the hell are they going to make a movie out of this complicated stuff? And they did beyond a good job on that. So it was, they picked the right director, and obviously got some good actors in there. So that was fun. And then up until 2019, Vincent Daniel and I ran a long-short financial services fund. And at that point, we basically had enough. And as people who are watching the financials today can see, it's a terrible sector. And it's so macro related, and we decided to spread our wings a bit. And we've been doing basically global long short financials, which is essentially a lot of macro. And so we spread our wings and became a family office at that point, and now doing all sectors. And we've thankfully had a pretty good track record over the years. We've sort of had we had one down year in 2016, which we were too bearish, shockingly, and we've had 3 plus 100% years in that time span. So it's been a pretty good ride. And as we like to say, covering the financial sector, once you see how the sausage is made, it's really hard to be all that bullish. And when you see the leverage and you see just how it's constructed, it just it's not conducive to being bullish. Some of our juniors used to come in and they'd be all these bright-eyed, bullish guys, and years later they're like, "Oh, what did you do to me? I can't find any longs. I'm so bearish." And so it's pretty funny. But with that being said, you don't put up big returns by being a short seller, and you have to. At heart, I'm a value investor. I like to stay away from trouble, and being a short seller, you have to identify some of these things where the real problems, and whether you can keep people away from it, like we did in '08, or recently we've been short Silicon Valley and some of the banks, and so that's what we do.
Let's see at that point about being a value investor when there's so much co-movement within styles and kind of boxes when it comes to thinking about asset allocation. You guys, as I understand it, really killed it last year, right? You went, as I understand it, long energy, short tech, which was the layup spread trade, clearly. But if the argument is that financials are sort of a terrible sector in general, independent of what's going on the last several weeks, presumably that makes the value style as defined by the Morningstars of the world and the ETF issues of the world, makes that probably challenged in terms of outperforming growth, which is much more tech from a longer term perspective. Where I'm going with that is part of this breakdown in value or in financials is that I'd argue it killed the value trade almost entirely as everything went back into tech, right? Which was the clear beneficiary from a sector rotation perspective. Presumably that also has impacts on energy, just because energy is a larger portion of value style indices. So when you define yourself as a value investor, what actually is a value investor? Because it doesn't sound like it's purely sector based.
No, you nailed it. And I think when I say a value investor, we usually buy with a margin of safety. We like a lot of, I'd rather be a growth at a reasonable price investor, right? But I guess I'm just historically trained in sort of the more value sector. But yes, the answer is, you got to look at balance sheets as well. And so, where, you can pay a higher multiple for a cleaner balance sheet. My partner on a recent podcast talked about Google's balance sheet. It's godlike, right? These balance sheets are really, really good in the tech space. And so you can see why people pay higher multiples than they do value stocks. And so, we try to do a bit of both. It's hard to, when you see a big trade like that, yes, it's fun to swing at being, short the biggest bubble the world has ever seen, and going long, energy, and we're totally bombed out, hated. We've been long basically since oil went negative, and so we like to see these big trades, and really from a how we think about the world, we try to be thematic. Come up with themes or individual names that create the themes, and so at this point, you can see why tech is outperforming, right? Because they just don't have the leverage like the financial system does, and so that actually balance sheets are now better than tech balance sheets, and they're just more cyclical. But that's a different story.
On the balance sheet health point, is there more variability today in terms of balance sheet health compared to other high stress periods for markets? I mean, you mentioned Google. I mean, Apple's in that category as well. But are we in this kind of weird environment where there's just more dispersion of balance sheet health?
I think so. The odd part about where we are today is that a lot of these cyclical businesses, you take a look at the steel manufacturers, their balance sheets, you would expect them, in this environment, most people would look at a steel balance sheet and say, I'm sure they're heavily indebted, all sorts of stuff, but it's the exact opposite, and so this COVID period where you had, an inflationary period to revive all commodities has allowed all these cyclical companies to really improve the balance sheets. And so that's not really where the problem is. The problem that we see in the no easy way out is really the sovereign. And, here the sovereign is obviously connected to the banks, whether it's, the Silicon Valley or Deutsche Bank or UBS, that, our bearishness lies. And so, how do we get out of $32 trillion of debt, running a $2 trillion deficit at 160% in a couple of years, right? And so that's what we look at. The debt's been transferred to the sovereign, and over the years, through the GFC, and now all the debt's been transferred to the sovereign, and so that's our biggest hang up in terms of where we are from here. And they obviously took rates to 5%. And as you read in our letter, we said that they'd probably be done in early 2023, and they are done at this point. And I think that it's the path forward from here for them is very tricky, because the unemployment is still really low, and maybe that's obviously that's a lagging indicator, but there's a big difference between Main Street and Silicon Valley or commercial real estate, where a lot of the sort of hot button issues lie at this point.
I remember in 2008, one of the analogies during the crisis then was that the government was almost like Christopher Reeves in the Superman films, where he would inhale all the toxic fumes and take all the toxicity out of the environment to save whoever he was saying, and that the governments were kind of in that situation back then. I think at the core, the question is who bails out the bailers, right? Given what you're saying as far as global debt, which obviously I think everyone here would agree with. The problem that I have with the very, very ultra bearish argument is that it sounds almost like Armageddon, end of the world. And I've used that line many times on Twitter. The end of the world is the bull case. Some people, when they hear me saying melt up because we're in a pre-election year, they think I'm dismissing the seriousness of the financial situation, the sovereign debt situation. My response is it's actually the opposite. It's so severe that you can't necessarily bet on it. Play with that idea for a bit here, Porter. Am I wrong in that way of viewing it, that in a worst case scenario, this is in quotes it, and that you really can't bet on that? Because ultimately, this is ultimately about path when you're managing assets.
Yep, I completely agree. Like you betting on the end of the world is never a good thing. And to be honest, we were short Silicon Valley from 600 or 700 down to $100, and at $100, I said, listen, if they get the capital raise done, the stock's gonna lift materially. And so we covered our Silicon Valley short at $100, declaring victory. And I actually never thought, that betting on the end of the world is never a winning strategy. Considering that the balance sheet, while impaired from a mark to market perspective, there was no major credit losses. There was no, as opposed to Signature or Silvergate, there was no massive fraud there, right? And so betting on the end of the world is tough. And so I would think that at this point, if the world gets in more trouble, and we can already see inflation coming down, right? Real time indicators indicate that inflation is really coming off at this point. And so and the bond market's telling you that, right? It's telling you 2-year and the 10-year are both down materially today, and the inversion is becoming less and less. And so that's the only way the system saves itself, right? In terms of it has to go back to QE, go back to lower rates, and hopefully inflate the debt away. And so I think that's the probable way out of this. So again, we chose, when you say that, we chose to buy gold. And that was our way of saying, okay, I'm not 100% sure that the path of, that buying the 10-year and hoping for lower rates is the right answer. We just sort of said, hey, we'll choose a defensive asset. And then at the same time, park a lot of the cash in short-term 2-year rates. And so that's sort of how we're thinking about it at this point.
Yeah, and I definitely want to touch a bit more on gold. I mean, I always go back to there's sort of 4, in quotes, risk-off plays, right? Treasuries, as you alluded to, gold, the dollar, and then on a relative basis, the utility sector. Consumer staples will be a part of that. Last year was the dollar's run. This year looks like it's gold's run. Just kind of interesting to see how the rotation of where the risk-off money is going, which we should tease out. But I want to get some of the audience. Let's go to...
Yeah. And so, listen, people have gotten their head handed to them in bonds over the past year. And you can see as people, the S&P chops around. The S&P has been flat for, I think, 2 years now, and it just chops back and forth. And, one day we're risk on, one day we're risk off. And so, you have all these savers out there, and they're sitting there and they can finally get a yield, right? There's a lot of stuff out there that, the balance sheets, again, of a lot of these companies are in pretty good shape. So I'm not picking, there's a whole list of shitty companies out there, but there's a whole list of good companies at high yields at this point. And so, if you're a good junk investor, I think it's a pretty good time to be, picking through stuff. And listen, I've been railing on passive business for a long time. And so I think in fixed income, passive investing is one of the dumbest ideas of all time. And so I think you really need good bond managers out there to pick individual securities and analyze the balance sheets. And I think that's where it's particularly important. So yeah, I could see, people want to really go back to finding yield and finding fixed income, which you can get for the first time in a long time, right? Well, I mean, listen, the guys like Barry Sternlick or the tweet you're referencing, they're crying basically, right? So that I call them the glass jaw bros, and they've had a 40-year glorious run in rates where rates have gone nothing but down, and they've made vast fortunes of just levering up, refi, lever up, refi, lever up, refi. And they did it all the way down to the bottom, and then now they're crying because inflation's gone hot, and the Fed's had to raise rates, and they're worried, so-called, about the banks. At this point, where they're just trying to save their own ass in terms of not trying to roll over their own debt. And so, I have zero sympathy for those people. And yes, the answer is yes, it's a problem, and there's a lot of fundamentals that are rolling over at the same time. Obviously, office is the key one, where the business has really changed, and the way people utilize office space, and the leverage is there, and the debt's at a low rate, and it's all going to have to be rolled over at some point. And there's going to be hopefully some shakeout in terms of the multifamily space. The multifamily space has been a very good one, obviously, for a long time, because the fundamentals have been so good. They're very low inventories all over the place. And then commercial real estate's been sort of a walking train wreck for a little while. So that's I think it's going to be messy. I think it's you had this, in terms of the everything bubble. The everything bubble included rates, which included obviously commercial real estate. So I think it's going to take a long time to unwind. I'm not saying it's going to pop and be a disaster, but I think it's going to take a long time for this thing to fix itself. And so, a lot of these look at Blackstone. It was the 800-pound gorilla. It bought everything in sight, and they just waved in all these flows. And now magically, the Blackstone investors think they're going to have incentive fees in real estate for the foreseeable future. I just don't think. I think it's going to be hard for them that to happen. I mean, it's very obvious that credit is tightening. I mean, it has to when the banking sector is competing with the government for capital, and the deposits are flowing out of zero cost deposits and going to government money markets. The bank's balance sheet is going to contract, right? And that's an inevitability. So, a real estate investor complaining about the resetting of an arm, right, or a debt maturity coming due, that should have been part of their due diligence and research, but it wasn't, because they said, "Oh, rates only go lower. I'll forever be able to refi out of this stuff," and so into lower and lower cap rates, and it works, right? So, but they just didn't think that way, and so fuck those guys, right? I don't know. If you don't put it in your as part of your research on a massively levered debt, that's capitalism, right? That's the downside of it. And I don't think there's enough capitalism out there in terms of the natural business cycle. And so the more we see natural business cycle, the better we see good operators survive and bad operators go by the wayside. One of the things I'll say is that that being a active investor, like everyone on this call, is the game's a lot harder, right? Because you have the advent of passive investing, you have supercomputers all over the place, and you have these massive relative value firms like Citadel and Millennium, where they have trillions of dollars at work carving out arbs, and the people doing that business are super smart. They have the highest, information advantage, and then the supercomputers are doing the same stuff. So the game has changed, and so I think that when Vincent and I became a family office and tried to exploit some of these idiosyncrasies and see, like, how do we beat the market? How do we create a good risk adjusted return? We sat back and said, listen, we got to do things a bit differently, right? And you got to, again, find companies with margin of safety, and find companies where the risk reward is 2, 3, 4, 5, 6 to 1 on the risk reward. And so I don't know Signet that well, but if you think the balance sheet's good and you think that the earnings growth is all right, I think go for it. It's fine.
But just real quick on that margin of safety point. I mean, I'm pretty sure if you're too big to fail, that's the ultimate margin of safety, right? I mean, even within the banks, I think you'd be hard pressed to make an incredibly bearish argument on J.P. Morgan Chase.
Yes,
given the regional and I think that makes it different that makes this environment, I'd argue, different than 2008 just from that perspective alone.
Yeah, I mean, the margin is too big to fail is a whole nother issue. Yes, J.P. Morgan is way too big to fail. So is Deutsche Bank, and so is Credit Suisse, right? And so, if you're buying Credit Suisse these days, you're buying the Swiss government. If you're buying Deutsche Bank, you're backstopped by the French government. If you're buying J.P. Morgan, I think you can look at the bank preferred business, right? If you're buying bank preferreds, and you don't think the bank's going to go under, that yield should be as good as an agency mortgage yield, right? And because they're essentially backstopped by the government. That said, some of these, we were looking at Western Alliance bank preferreds the other day. They're 9-10%. Given the situation, I don't think that's enough yield and enough margin of safety for to buy, right? And so It's a tricky business. When I say margin of safety, I mean, cash on the balance sheet. You're thinking about book value. You're thinking about, loan loss reserves as a bank, stuff like that. Where obviously goes back to margin safety. Good management team. If you're a value investor and you expect to outperform tech and outperform all the passive flows, you better have a management team that can execute on your vision and return capital to shareholders, grow the business, all that stuff. If you think about Silicon Valley, right, it was probably the most sophisticated, or should have been the most sophisticated deposit base in the world, right? All institutional investors, all backed by VCs, and they knew the FDIC limit, right? All the corporate treasurers knew the FDIC limit, and it was their risk, and they said, hey, our business, Silicon Valley, is too important to our business to care about that, and they made that choice, for right or for wrong. The deposit insurance question is a tough one because Yellen, you can see her flip-flopping on it. You can see Powell flip-flopping on that, because eventually, if you backstop uninsured deposits, it ties the banking system to the sovereign again. And as soon as the banking system goes down, the sovereign goes down, and it ties it again. And so you look at the European situation; they didn't, they put temporary ties on deposit insurance. And so I think it's, I have little sympathy for the Silicon Valley depositors. I have a lot of sympathy for mom and pop depositors that may be over the $200,000 threshold. But I have little sympathy for the large depositors, because they knew, right, and that's why they all yelled fire at the same time, and they all killed themselves in Silicon Valley. Well, listen, the problem with all these bailouts and risk taking is that it's all tied together, and suddenly no one's held responsible. And so if you create an environment like that where there's no risk, the government will bail you out, of your real estate loans. Oh, please do something here. It's a slippery slope. It's student loans. It's it's Medicare. It's all this type of stuff. And so it seems to be the bailout nation, and I just don't think that's going to stop at this point, right? QE is going to be with us forever. Sadly, that's the state of our market. And I see Powell trying to walk the line in terms of deposit insurance. The problem is that there's some odd stuff with it, with the FDIC insurance fund, is that they're trying to get back to, by law, Congress, I think in 2020, put into law that they're trying to raise the level of protection. But the problem is that they didn't expect any bank failures, and now you have at least 2 or 3 bank failures this year, and maybe a couple more. And so they're sort of already behind the 8 ball in terms of the FDIC insurance fund. So again, it all gets tricky, and again, it's all tied to the sovereign, right? And so, I think there was, everyone was kept on talking about raising rates until it broke. Well, things broke here. You saw that, the world couldn't handle a 4% 10-year. It just couldn't do it. It broke, and so I think that's you now know the top of the end of the 10-year government bond, where the world essentially just doesn't work. Sad. There's too much debt.
Everybody here, please make sure you follow Porter Collins on Twitter. And let's go to.
Listen, I agree with a lot of this. I see a lot of calls. I mean, virtually everyone going, this is not 2008. Yeah, and I don't disagree. The problem is that when the banking sector is under question, it is 2008, right? In terms of that was a banking crisis, right? And so, Steve Eisman, who I love, he was on a podcast recently, and he was talking about how, and I don't know if I would have disagreed with him at the time, is the banking sector is in such a better place than it was in 2008. And I completely agree. And they've done a lot of good things. That said, the banking regulators failed massively here, right? And they ignored a lot of risks, and they allowed a lot of these companies to run around with negative tangible equity. There's still a fair amount of them around there with running around with negative tangible equity. You just shouldn't do, right? And then I can get into the whole Goldman Sachs conspiracy theory that on Silicon Valley, that Goldman Sachs sold Silly Valley all these bonds, gave him probably the most horrific financial advice of all time, and then bought the bonds back from him at the peak and completely wiped out the company. But that's a whole nother rabbit hole that we don't have to go down. But
let's go down there. No, because FinTwit would love to hear that, sure, but no.
I mean, listen, the Goldman Sachs was selling them the bonds. They were the ones. They were the bond broker, right? They were the ones who loaded the balance sheet up with all the low rate bonds, and then they were the financial advisor for them to raise capital. And I don't know if I've ever seen a more botched capital raise. That if you're doing an emergency capital raise that everyone was completely not prepared for, and have one block of capital spoken for and the rest just completely open, that's what caused the run, right? And that's when Peter Thiel yells fire and get out, and let's kill everybody in between. And so and then Goldman, of course, bought the bonds back from them at the absolute dead low. They're going to make a fortune on that too. So that is a lot like 2008.
It's just interesting to me that everyone automatically goes to that as the framework. So there's a guy who sent me a direct message showing credit default swaps on Capital One, right? And it got to the sort of, I think, the highest since 2020. I said, okay, well, let's zoom it out. Let's look to 2008. He got the chart, and it's still nowhere near the 2008 type credit default swap. So everyone's saying 2008, but even just from a CDS perspective, you're not seeing anywhere near that type of panic.
A lot of people are talking about that Capital One CDS thing, and that was brought to our attention last night. And my partner Vincent there's probably no one better on planet Earth that knows Capital One than him. There are a couple, but it's totally fine, right? The balance sheet's extremely liquid, very good, and I would actually say that if anyone's prepared for this cycle is Capital One, right? Because they have always had on the asset yield side, they've had credit card asset yields, which are obviously very high, and then they've had sort of at market rate deposits. They don't have a lot of these low cost deposits, and so they're sort of more interest rate protected than other banks at this point, and the balance sheet looks fine to us. And again, it's definitely in the too big to fail category. That bank is not going anywhere. So I think it's one big buyer buying a lot of bank CDS at this point, as it feels like to me.
So I tend to always think of things in terms of it's never the obvious to worry about, right? It's either the secondary or tertiary effects of something, and that ends up surprising the markets, where a real crisis tends to manifest. Aside from the commercial real estate side, are there risks that you think people are not really appreciating that might have nothing to do with the regional banks?
One of the things that got us in the Silicon Valley short was, you think about the tip of the spear in terms of risk and bubbles was all the loan portfolios. So Silicon Valley doubled its loan portfolio post COVID, and you can imagine the health and quality of that borrower base. That just underlying fundamentals are just not good, right? Just all VC companies, while the hit rate on those from an equity perspective maybe 5, 10, 15%. When you're lending to companies, you want your hit rate to be 100% in terms of not going bankrupt. So, I think there's still some VC fallout that listen, everyone put their money into some speculative private equity, or VC stock in the last cycle, and the SPAC boom was part of that. And those are probably pretty much all dust, or the valuations were 99% too high, right? And so I still think that the marking hasn't gone on a lot of that stuff, and so that's the whole private equity or VC marking, that no one marks anything. So that's another issue that listen, the bad thing about mark to market accounting is it doesn't give you time, but the good thing is the mark to market accounting, it's all right there. It's the risks have been are shown, and so there's a bit of a balance between that. Well, the SIFIs are a net. I mean, Yellen essentially said in her testimony that she doesn't really care about a lot of these smaller banks. They have a hard enough time regulating, as it is, and so I would assume that they're going to want less and less banks, and less banks is going to happen, right? They're going to keep consolidating, whether by failure or not. But J.P. Morgan is in a really good spot, right? And you think about all these corporate clients, and they're going to want to put their they have a lot of cash, and they're going to put it all in essentially a lot of these big banks, which is the sovereign. And so I think it puts the regional banks in a much more tricky spot. And again, back to our letter, which we talked about in terms of when you have the Fed funds rate at 5, and you had a lot of low cost, lazy depositors sitting there at the one I pick on recently is Schwab. They have $375 billion at 40 bips. So you have 375 billion people sitting there earning 40 bips on their money, right? As soon as when people wake up and they either rotate that into a higher money market yield or into a short-term government money market yield, I think that's what that crushes the regional banks. So I think you're going to see an earnings degradation from all the banks too. And so another side point where people are talking about, is this expansion QE or not QE? I think it's sort of a stupid argument, but it is QE in the fact that it is an expansionary monetary policy, because you're not destroying capital, you're just recycling that. If that money goes into the big banks, and then the big banks are out there forced to go into the out and buy treasuries, or if the Schwab client transfers his money to a government money market fund, they're essentially buying government bonds again, which would be the same security that the government would be doing. So expansion, you call it QT or not QE or not QE, it's expansionary. And so I think gold has responded accordingly. Obviously, Bitcoin has done very well, and the tech stocks have done very well. The transformation was almost immediately, and people doubt even before it was going to happen. That's how much people are glued and addicted to QE.
In environments like this, Porter, do you find that the portfolios that you're running, you end up having more turnover? You're acting quicker? Do you take a different stance on positions that's a 180 from your prior view? Yeah, I always go back to path matters more than prediction. So a lot of people will talk about macro and risks, but it's always a question of how do you manage it. And candidly, listen, I've been bullish because I think the conditions are there, especially this year. But I don't think it's outside the realm of scenarios to see the market get past this, which really emboldens the bulls, which could create like a really stupid move higher, because everyone just says, well, the hell with it, everything's going up.
I don't disagree with that. I mean, I think that the bears want to get very bearish right now, and you can see them, and they're getting bearish for the right reasons, right? Because like, how the fuck do we get out of this stuff? Like, how do we get out of $32 trillion of debt? And the only way out of it is higher taxes or something. But they're probably not going to do that. And so that's what the bears are looking at. And the bears are looking at the banks, which are total clusterfuck in terms of lower earnings and deposit flight, which I think in terms of to arrest this problem, you're going to have to arrest the deposit flight at some point. But then the bulls are looking at, we got QE again. I think the economy is a very different animal than historical cycles, right? And I think the COVID period screwed so much of it up and made it so herky jerky, right? In terms of you've had the accordion, the supply chains really quickly. You've had customers or people going out and spending a lot of money, then not spending a lot of money. And then you have China, which is, first or second biggest economy in the world, go to lockdown for 3 years and then suddenly reopen. And then you have, demand for, coking coal, making steel at highs. And then yet people expect the world to break down. And then they have, again, the advent of algos and supercomputers. You have people, crush oil $10 as soon as there's a banking crisis. And so I think there's just a lot of odd movements. And so, for us, we try to, on the short side, really rifle shot companies with problems and bad balance sheets and bad business models. And, and then on the long side, again, pick stocks where, you have a risk reward that's something like 2, 3, 4, 5 to 1 on the upside, or 2 to 1 on the upside. And so that's sort of how we mitigate a lot of the noise. Again, I think, we talked about our letter, despite, all the shitty market last year, we put up the returns with being fairly net long. And so, being a short seller is very, very difficult. And you really need to know what you're doing. You need to know how to trade these stocks, as well as, identify inflection points. Because, when you're fighting against QE, fighting against a lot of these algos, which pick out high short interest stocks and, try to screw you on the other end, like, it's just a very difficult game. I mean, look at these meme stocks. They're just very hard to kill. Could you imagine an environment 20 years ago where Bed Bath and Beyond would have existed and not gone bankrupt, right? Or GameStop, or Hertz, or any of these examples, right? And I think it's just a very, very different market than it was 20 years ago when I first started. The FRC example is pretty easy. I mean, they've, I think a last number I looked, they had $110 billion of deposit outflows. I mean, that in itself is impossible to survive. Then they have, I think the number is $100 billion of fixed rate mortgages, which is a lot lower than the market. And, if you want to sell those and people, want to get a reasonable yield on those mortgages, you're talking about a, 30, 40, 50% haircut on some of these loans. And so obviously when you have to sell immediately, it makes things very difficult. So that's the, headwind that FRC is facing. Obviously, there's a lot of other parties involved, and whether you like it or not, rich white people get bailed out all the time. And so, this is a rich white people's bank. And so I would think most of the depositors that are above $250,000 are out of it now, and, giving time to clean itself up. So that's my take of it. A lot of these banks they were in a bad. First Republic is one we've been short for a while. It was the wrong spot. And I think a lot of these growth banks really got in trouble because they had so much in deposits from COVID, right? And all the money printing that went on, and they were the beneficiary of all the growth and all these deposits. And then a lot of them made really, really bad interest rate bets, and with no hedging on the other side, and obviously no federal regulation oversight on the other side of it, right? The regulators buried their heads in the sand. And I go back to the Fed, and I'm pretty vocal about being a Fed hater. The biggest thing that I hate about the Fed was especially from '08 was the awful regulation. I mean, Greenspan deserves to go down as the worst Fed chairman of all time for the utter lack of regulation that occurred in 2008. And so here, you could see Powell in the press conference, how pissed he was at Barr, the vice chairman who's in charge of regulatory. And he said it in the press conference, he goes, "How did we miss this?" And he said, "We kept on asking ourselves all day Friday, how did we miss this?" And so I think in that sense, probably the regulation is going to probably higher and tighter. And so do I think that First Republic makes it? I don't know. If it does, it's a total zombie, and maybe can be pieced together like Humpty Dumpty, but is it worth investing in? Probably not.
Maybe just for the last couple of minutes. I mean, I think part of being a great trader is knowing when to swing big, right? When there's a a fat pitch. Is there anything? I mean, you kind of alluded to gold. Maybe that's the fat pitch. But is there anything that you're eyeing that is a fat pitch for people now that really could cause some real outsized returns? Energy was the one for last year. What do you think is the one this year?
And well, I mean, we've been highlighting gold up, especially in the fall of last year, and on this pullback. I just think that the QE is was and is an inevitability, and if you look at the gold, it's sort of sniffing out the end of the rate hikes. And, in mid February, when it sort of came down, that was the point where the economy was reaccelerating, and maybe the Fed needs to, do more rate hikes, and the gold sold off again. And so, gold's just the inverse of Fed credibility. I think it's Jim Grant quote, right? And so the Fed has virtually no credibility at this point from being a regulator, right? They had 13 years to fix it post crisis, and they fucked up pretty badly here. And then from a rate perspective, they can't hike rates anymore, and so they're at the whims of wherever inflation goes at this point. And I think inflation's heading lower, but even if it headed higher at this point, there's nothing that really the Fed can do, because they've shown you that they can't hike rates pretty much anymore at this point. And so that's why I think that, listen, gold does not, as anyone who's owned gold, is not going up in a straight line recently. But if you look back to the 02 to 2010 cycle, it was a pretty glorious run for it. And, people might hate, a lot of people hate Bitcoin, and I'm not I hated the whole crypto fraud stuff, but the Bitcoin, I don't own any Bitcoin, but I can see the point of a lot of the Bitcoiners that you want an elegant solution that that's more portable than gold, and so I understand that thought process.
I think that's a good place to wrap this Twitter Space up. Thanks to everybody coming up and asking questions. Special thanks, obviously, to Porter Collins. Make sure you follow him